Hello and welcome. Thank you so much for being here. If I asked you whether you support one of the recent proposals to increase the corporate tax rate to 28%, chances are your answer may be a yes. By the way, right now the rate is 21%. Recently, the corporate tax rate increase was part of a budget proposal that was made by the current administration. It has been shared with the United States Congress, and at the time of the video, it has not been approved. While this type of laws typically may sound really good on paper, their result is not what you would think. Their result is not what they want you to believe. Even if approved, additional taxes paid by corporations won't hit their bottom line. Instead, it will come out of your wallets. If you are interested in this type of content, consider subscribing to my channel. I would love to have your back for my next one. Raising corporate taxes hurts the economy as well as all consumers in more than just one way. There are two major negative impacts of raising corporate taxes. Investment activity will slow down and so will economic growth. By reducing capital investment, this higher corporate income tax reduces long-term productivity growth, and I'm sure by now you know what that means. It means that lower productivity results in lower wages. So consumers will also be hit with higher prices that these corporations will set to make up for an increase in tax expenses. Remember that corporations will pass any additional costs to customers in order to keep their profit margins as high as possible, and naturally they want to please their shareholders. A recent research that was done by the Tax Foundation and nonpartisan think tank serves as the proof that the idea to hike corporate tax rates is just a game to distract and to misrepresent the reality. We really need to look at the numbers, which is what I want to do here in today's video. So the research shows that raising the tax rate reduces gross domestic product by $720 billion over 10 years. GDP is the key measure that tracks the health of a country's economy, and it also represents the value of all goods and services that are produced over a specific time period. Simply speaking, GDP shows whether an economy is growing or if it is contracting. Based on the research, the drop in GDP would be approximately $160 billion of lost output every single year. That number seems really high, but what does it really mean for us? In one way or another, this will have a significant impact on every single person who lives in the United States, because it will result in a decrease in incomes for everyone across the board. The capital stock, which is of course tied directly to your retirement savings accounts, as well as your investments, your wages, your salaries would be lower. That's how the drop of roughly $720 billion will affect consumers, will affect all of us. The budget proposal is expected to bring in more than $4.5 trillion increase in tax revenue that the government would collect. Of that total amount, the increase in corporate tax rate is estimated to bring in about $1.3 trillion. The Tax Foundation created an illustration that shows annual decrease in GDP. Let's take a look. For example, in year one, output would be about $8 billion lower than in year two. Output would be another $19 billion lower on top of the $8 billion lost the previous year, which results in a cumulative loss of about $28 billion. Now let's look into how the increase of the tax rate to 28% affects an average employee, an average worker. The Tax Foundation estimates that in the long term, taxpayers in the bottom quintile would see their after-tax incomes drop by 1.5% on a dynamic basis. So if you want to know how much lower your income would become if or when this proposal goes into effect, here are some details. For example, in the second column from the left, if your AGI stands for adjusted gross income, is between $50,229 and $80,159 annually, the corporate tax rate of 28% would lower your income anywhere between $3,500 to $4,600. So roughly speaking, it will take away 1 or 2 of your paychecks a year, and you will work 2 weeks for free. So as you can see, this is extremely counterintuitive. Higher corporate tax burden is meant to depress those who need a tax break the most. The question to ask here is, why would any finance expert or why would any tax expert make a proposal of this sort? This type of research that I just showed you should have been done beforehand, before the proposal was made. It is clear that the real goal of the proposal, of course, is to increase federal government tax revenue as much as possible, as quickly as possible, without showing any regard to how such policy would affect an average person who's working a 9-to-5 job. Passing corporate costs to consumers isn't something new, of course. When the pandemic started, there were many issues with the supply chain, with remote work environment, and so on. I'm sure that you remember. So it became a lot more common for companies to make up for that increase in the cost of inputs such as material, labor, and overhead, through making consumers pay more. Of course, inflation played a role, but that was a contributing factor. For example, Reuters reported that big companies managed to pass on costs to cash-strapped consumers. The article pointed out that makers of chocolate bars, of coffee, and lawnmowers, and everything in between succeed in passing on those costs to consumers. According to another source here, in fact, the majority of companies, 80%, pass on rising costs to consumers, and this is according to one of the surveys conducted by the Federal Reserve. It goes on to say that CFOs are also absorbing higher prices by reducing profit margins, by cutting costs or eliminating products, adding contingency clauses to contracts, and turning down work. I've asked my subscribers whether you support the increase in corporate tax, and I have to say that the results were very interesting. If you participated in that poll a couple of days ago, thank you so much for taking the time to do so. The majority of those who responded are actually against the tax hike, while about a quarter of those who responded is in favor. As you can see, based on the data that I just shared, corporate income taxes are one of the most harmful ways to raise revenue. They place a higher burden on investment, they reduce economic output, and they also reduce after-tax incomes across the board for everyone who is actively working. So negative economic effects truly compound over time. Hopefully this quick video helped clarify the impact that something that appears to only impact large corporations has on average consumers. Thank you for watching. If you enjoyed this video, give it a like, subscribe to my channel. I would love to have you back for my next one. And if you know someone who might find this information helpful, please share the video with them. I'll see you in my next one tomorrow. Take care.